Special guest today, Mr. Taher Badshah, Chief Investment Officer, Equities. Mr. Taher has over 24 years of experience in the Indian equity markets. In his role, he is responsible for the equity management functions at the firm. He joins Invesco Asset Management from Motilal Oswal Asset Management, where he was the head of equities, responsible for leading the equity investment team. In the past, he has also worked with companies like Kotak Investment Advisors, ICICI through AMC, Alliance Capital Asset Management, etc. Taher holds a master's in management studies, MMS, with specialization in finance from SP Jain Institute of Management and a BE degree in electronics from the University of Mumbai. His huge experience and an exceptional knack of picking up contra bets is certainly going to benefit our participants today. He manages 4 funds, that is Invesco India Contra, Growth Opportunity, Dynamic Equity and Bond. And the total size of the funds together is USD 1.2 billion. So correct me, Taher, if I am wrong anywhere with it, because I picked it from Bloomberg and hope this to be correct. Invesco AMC, yes, sorry.
Well, our total domestic and foreign assets put together, offshore assets put together, is now nearly close to about $2.5 billion.
Okay, great. So also in this webinar, Invesco AMC has launched an NFO titled Invesco India Focus 20 Equity, which we will discuss in the presentation, which is going to present. And this sounds interesting, this NFO, because this is a focused approach of investing in high conviction 20 ideas and with proper diversification. This is what I could gather from the website. So hopefully that's going to be quite interesting. So with this, thank you, Mr. Taher Badshah, for joining us. And yeah, so before we start, I would like to briefly introduce Ashika Group as well. So we are a quarter of a century old financial house having pan-India presence and deep-rooted existence in the Northeastern region, broking with over 1 lakh clients, 350 plus partners across India. Our investment in technology in the last few years have made us digitally equipped to adapt to the presently changing business landscape. We are empaneled with almost 100 institutions and serving to 100 plus family offices. We are also into investment banking, wealth management, AIF, mutual fund distribution, NBFC funding, and so on and so forth. We have received awards and accolades for the best broking house in Eastern region from NSE for 2 consecutive years. That is 2017-18 and 2018-19. Also awarded for maximum number of accounts in DP in Eastern region from CDSL. So that's about us. Now I move on to the structure of the webinar. So Mr. Taher will present and give us broad outlook on markets and from business partners, APs and HNIs. And I'll try to squeeze in questions as well from my side. So over to you, Mr. Taher Badshah, please.
Hi, good afternoon, everybody. Thank you, Paras, for the lovely introduction. Thank you, Ashika Group, for hosting us on your webinar today. I also would like to say that I have now started to track your your research, your recommendations quite closely nowadays in the last some time. So keep up the good work. You guys are putting up some very interesting recommendations and opportunities and ideas as I've been watching over the last some months. So congratulations for the kind of work that you guys are doing at your end. And thank you once again for organizing this, plus making those necessary accommodations. I hope I understand that it could have inconvenienced a few participants, but it was circumstances beyond our control, as a result of which we had to prepone this event. First off, of course, we know that this is a very challenging environment. We are all going through very tough times in our lives, in our career, in our businesses. And let me therefore at the very outset wish everybody on this webinar safety and good health. I hope you guys are all taking good care of yourselves and your families. But we also know that when the going gets tough, the tough get going. And we at Invesco are not getting cowed down by the current state of affairs around us. We are therefore, we continue on our efforts to bring you quality investment products. And in that continued quest, today, as you can see the banner behind me, we are currently in the midst of the launch of our latest offering in the mutual fund space, which is in the focus category, labeled the Invesco India Focus 20 Equity Fund. So I will talk about that a little later, but I'm sure you guys want to first know as to uh, how we are conducting ourselves, how are we thinking about markets, etc. So let me quickly dive into that. Well, at a very global level, to begin with, the way Invesco thinks about it at a global standpoint, both from a macro economy as well as a market standpoint, is look, in the last 6 months or 7 months of this year, particularly during the crisis, since the start of the crisis and up until now, uh, the economies around the world, almost every country by exception, has managed to avert a liquidity-led crisis. A liquidity crisis to that extent has therefore been successfully managed and averted by most countries thanks to the monetary and the fiscal stimulus which has been provided by almost all governments and all central banks around the world. From here on, we move into probably what is going to be the solvency phase, and it will be a phase where businesses will be tested. There will be a good number of probably unknown outcomes as we go along. This will unfold probably over the next 2 or 3 years' time, when there will be material implications, positive implications for some businesses, and perhaps, unfortunately, some very negative implications for certain other businesses as well. So there will be businesses which will consolidate, there will be businesses which will gain, and maybe there will be some others who will probably be weaned out as well. Now, in this regard, when we think about the recovery of the economies around the world, we think of it in terms of two templates. The first template being that what is the nature of the economy? If it is a more of a manufacturing-led economy where perhaps the reallocation of capital and labor is going to be relatively lesser, then that is an economy. Those kind of economies will probably have a faster path to recovery, and recovering back to pre-COVID levels, and then maybe even exceeding that. But economies which are relatively more driven by uh, services, such as ours, for example, which is, India is 48-49% a services driven economy. Where there's going to be relatively more reallocation of labor and capital, will probably take a little longer to recover. The recovery process could be more jagged and slower as well, compared to probably the rest of the world. India, of course, along with which also has that additional overlay of the fact that 80% of our population, 80% of our workforce is in the unorganized sector, and that has its own set of challenges too. So we may want to think that India probably perhaps might lag in terms of the overall recovery compared to the rest of the world in a post-COVID environment. Now, with therefore this basic backdrop, when we look at also the twin engines of the world economy, which is basically the US and China, we feel that their ability to come back to normalcy will probably be much faster, even though they might have the continued issue between the two of them in terms of the US-China trade-related matters. But independently by themselves, US, when it came into the pandemic, also it came with through a relatively better from a better position altogether. In this crisis, their banking system and their overall economic system was in a relatively better shape compared to what it was, let's say, at the time of 2009, 2008, 2009, post the global financial crisis. During which time, as you recall, their banks and the banking system was significantly challenged because of the mortgage crisis. Their capital had been substantially depleted and impaired. And therefore, even at that point in time, even though the Fed provided as much of stimulus, probably in percentage terms at least, um, uh, it took a long time for the US markets to recover, because most of the monetary support and the stimulus which went in, or the liquidity which was provided, went into repairing the balance sheets of many of these banks. And up until then, that took almost 2-3 years, and after which they were able to probably claw back and start gradually coming back to that 1.5-2% GDP growth. And then since then they have done reasonably well. I mean, it's not been very strong growth of the magnitude of 4-5%, but it's been very steady expansion of the US market, which has happened over the last 7-8 years. In the meanwhile, in the process, their banking system has got significantly deleveraged as well, almost to the extent of 65% compared to what it was during the 2008-9 period. So we believe that their starting point is good. Even from the point of view of households, the households have actually their savings levels have gone up. They have also been significant beneficiaries of a continuous fall in interest rates, And that means that their starting point is much better compared to probably many other countries. So we would like to think that as soon as the problem of the pandemic subsides, in the coming year or so, in the next few months or so, if all goes well, their economic expansion will be far more vigorous than for probably the other countries in the world. The second engine, which is China, also this time around has behaved pretty well, despite the fact that the problem has started from there. They have come around this problem very, very well. Moreover, in the last course of the last 8-10 years, they have materially shifted the focus of their economy from it being an investment-driven economy to a consumption-driven economy. So that also has been quite successfully achieved. And therefore, it is now a lot more domestic economic driven than it was probably earlier, somewhat similar to what India is today. And thirdly, I think they have also deleveraged their banking system. Their shadow banking problem, which started before our NBFC problem started 2-3 years prior to that, has also now come under control. And lastly, in fact, if you see, in this time, China has been the one country which has not actually resorted to any stimulus of any meaningful magnitude. In fact, they were the first ones to actually stimulate their economy post the 2008-9 crisis, even before the US. So they have managed to recover without any, great support of stimulus. So I think if these two engines do well on their own, and probably if the US-China related matters do not become very center stage, particularly post-elections, then I would like to think that they will add to the overall world growth atmosphere, and I think in the process it will benefit some of the other emerging market countries like India as well. Coming to the domestic economy, India economy, well, we have even in the since the late of 2019, second half of 2019, we have been incrementally running with a positive view on the Indian economy. We have been thinking that India's economic growth could be modestly better in 2020-21 compared to what it was in 2018-19, and that was predicated on a few factors. One was clearly the fact that we were coming out of a banking problem, which was almost bulk of the large NPA related problems were behind us. There was some bit of stress remaining, but not of the magnitude which was there in 2013-14. So a lot of ground had been covered in that regard. We also had an NBFC related crisis starting ILFS in November 2018 as well. But even that had started to subside by the late part of 2019, thanks to, once again, the RBI's liquidity drive, the fact that interest rates were falling. Of course, it led to a situation where there was a upheaval in the NBFC space, where the large became larger and more stronger. But the overall availability of capital and cost of capital started to kind of moderate, and that actually helped the overall atmosphere as well. So we were going in with that, along with which we were seeing good signs of a recovery in the the semi-urban and rural markets, thanks to the last year's monsoon as well, which was pretty good. And we were starting to see inflation in commodity prices actually improve, food inflation getting better, which also would have probably contributed to some higher discretionary income compared to the past few years for the rural segment and the non-urban centers. However, unfortunately, this got interrupted by the pandemic in the last 6 months. But when we think of it, some of these trends are still kind of quite valid. In fact, this year's monsoons have been, also have been good enough. So essentially, the rural story has got stronger because of good back-to-back monsoons. Plus, of course, a lot of the ongoing support which is received by the rural segments in terms of all the rural programs, government support programs, which only have got bigger and bigger as time has gone by. From the point of view of interest rates, India is actually now at a stage where interest rates are the lowest ever in a very long period of time. This is the first time, in fact, that India is actually starting to have negative real interest rates with the repo at 4% and inflation at around 6.5%. Although inflation has spiked up in the last some readings, but I think it will settle down. So we don't really fear the last some readings of inflation. And I think that lower interest rates in the system are here to stay. Meanwhile, what has also happened, interestingly, is that the transmission rate in the system has actually started to get much better than what it was even pre-COVID. So even pre-COVID, we were actually seeing repo rates come off 6.5 to 5.15, and post-COVID, 5.15 has come down to 4. But much more of the 5.15 to 4 has got transmitted compared to earlier. So I think it is helping the borrower as well. Uh, Most parts of the lending borrowing system, whether it is mortgages or whether it is personal loans or any other form of lending, borrowing is actually coming at now a relatively more attractive cost to the customer. Uh, Lastly, with regard to the banking system challenge, yes, because of the hit of the pandemic and the fact that there has been an impact with regard to lives and livelihoods, job losses, income reductions, cash flow reductions for corporates. So some part of it will definitely impact the banking system and cause a temporary uh, uh, setback to the recovery process of the banking system. But of, compared to what the outlook was in March and April, the situation is relatively better. It's turned out to be not as ugly as what we had all anticipated at this during April and May, particularly with respect to the course of the moratoriums. The moratoriums are now out of the way. Consumer behavior has been relatively better. Payment behavior has not become very vitiated. People are going back to work. So I think almost all banks or NBFCs have called out for a reduction in moratoriums without exception in the last couple of months. So I think the solvency risk, uh, I mean the liquidity risk which was there in the banking related system around March, April, May is not of the same magnitude as probably what it is today. It is much lower. So to that extent, there is a certain amount of relief. So we would like to think that the economy still has those legs, and even in our case, as the pandemic concludes or subsides, we should be able to kind of take advantage of some of these factors and build up or rebuild our growth over a period of time, over the next 2 or 3 years time. Of course, we'll have some challenges along the way, as I said, about labor, about capital, about government finances. Uh, uh, but I think there are some things which are also working in our favor, which would help our overall cause. Now, meanwhile, the markets have done what they have done, and it's a very massive comeback, as we know from the lows of March. We are almost back to where we were pre-COVID. But when you think of it, it actually at one level, it's a very, very structured kind of market movement. This is all in hindsight, but if you reflect back, you find that in the first instance, the market went up, or market preferred businesses where survivability was guaranteed. That was the first, gravitation. Investors moved towards those kind of companies where you were very sure that these companies are going to be surviving. And therefore, it was the Hindustan Levers and Nestle's, the Britannias of the world, because everybody, all of us were basically shopping groceries during that period of time. Then came the second phase where, as we got a little more clarity around the fact that, okay, we are not all going to kind of, vanish. There is going to be some reasonably decent survivorship. Markets started to then think about companies where there would be least impact or disruption to the earnings profile. And therefore, there was a preference for things like technology, IT companies, pharma companies, etc. In the third phase, then the market started to even think about, okay, earnings is not currently there, but can there be a recovery in earnings in the next 3 or 4 quarters, after 4 quarters? And then markets started to bet on recovery stocks, beta, mid cap, small cap, commodity plays, as the economy started to come out of the lockdown. So at one level, it's been a very orderly movement. But now where we are today, obviously markets are at a stage where valuations, at least apparent valuations, are not very compelling. And we don't have great visibility on earnings, at least for the next few quarters. So therefore, the market needs to kind of, in my view, at least take a bit of a halt, take a bit of a pause, pull back. After a 50% rally, I think a 10, 12%, maybe up to a 15% correction also would be a fairly welcome correction. I don't think anybody should grudge that. Do I think that there can be a much deeper correction of the magnitude of 25, 30%? I don't really think so. There is, of course, the support of global liquidity, but there is also the fact that we are gradually returning back to normalcy, despite the virus spread, because now the attention of the market has moved away from number of daily cases to what is fatality rates and what is recovery rates. And so long as recovery rates and fatality rates are getting better, it basically says that the a burden on the health management system, healthcare system is going to be under control. And along with which, of course, on and off, there will be this news around vaccines and probable solutions and therapies and treatments which will keep coming. So I don't think there can be a very sharp correction, many more things need to go wrong for a correction which is of a much deeper magnitude. But yes, I do feel that markets need to step back a little bit, reassess the earnings profile, take some breather. It will be good from the point of view of the longer term course of the market. If markets continue to go up like this without the great visibility of earnings, then it can have, then the fall at a later date might be even more vicious than probably what it might be today. So that's basically how I would think about the market. But at the same time, we also know that the whole market is not where it was when we had started off. Now, there are parts of the market which are still struggling, they have underperformed. In fact, the largest segment of the market, which is banking and financial services, has not played out at all. It is still well below what it was in January, February. And across names, I mean, banks, NBFCs, and even good quality, not so good quality banks, everybody is still well below that. So I think parts of consumer discretionary, particularly those which are leveraged to the urban centers of demand, I think those are also have not done as well, because the attention and focus has been more on semi-urban, agriculture related, rural related businesses, and so on. So I think there is underperformance. Parts of telecom have not done well either. Technology is not very expensive. I mean, it is fair, but it is not blowout expensive of the type that you feel a little uncomfortable touching them at these levels, particularly when earnings visibility for them is not as bad, and in fact it is getting even better. So I think there are pockets of stretch. Maybe there are some consumer discretionary businesses. There are some parts of the mid caps and small caps. There is parts of maybe even pharma which are a little overextended. But the whole of the market is not something which is on the boil, in my view, and therefore there will always be pockets of opportunity which we keep exploiting for the purpose of our funds. So that's pretty much what I wanted to share as my opening remarks on the market. Let me also quickly, give you in 5-10 minutes a flavor of what we are planning around this new offering. We are in the midst of this NFO. This belongs, like as I said, to the focus category. So essentially, as per regulation, you cannot buy more than 30 stocks. There are, of course, a good number of funds which are there in this segment. But we observe that most of our peers operate with somewhere between 25 and 30 stocks. Here we have chosen to actually restrict ourselves to a maximum of 20 names. And we believe that because we think that the whole purpose of running a compact, high conviction strategy is to run with a lesser number of stocks. Even our competitor strategies, actually, even though they run with 25, 30 names, we find that 80% of their portfolio is in about 15 names. And then they have a tail of another 10, 15 odd stocks, which takes the balanced 15 or 20% of their portfolios. So we thought that it takes away, it detracts from that whole principle of running focus strategies, which is about displaying your conviction. Therefore we said that let's restrict ourselves to 20 so that we don't ourselves get carried away and we don't give ourselves room to unnecessarily add tail to the portfolio. This whole principle of focus is something which is very exciting for us. I'll just try and pull up share a screen with you. Just give me 10 seconds to bring that up. Paras, please let me know as soon as you see this.
Yes, you can go ahead, please.
All right, thank you. So basically, we know that this whole principle of focus is something which brings some very strong outcomes, even in any kind of daily activity or any of our varied activities of life. Whether it is education, whether it is sports, whether it is entertainment, we have seen that example after example that anybody who approaches any profession with a far more focused approach delivers some very exciting outcomes for himself compared to his next door neighbor. Same goes for the world of investing as well. When focus intersects with the world of investing, we think that the outcomes are as similar, and we can get some very sharp, good quality return outcomes, provided you manage this thing in a nice and healthy manner without taking significantly undue risk. So this is a principle which draws us to this whole idea of running a focus strategy. From my own personal experience, I've had the good fortune of running some of these strategies in my earlier organization, in my earlier assignment at Motilal Oswal. Many of you might be familiar that we launched a series of these focus strategies, 25, 30, 35, at Motilal Oswal a few years back. I was happy to have actually had the good fortune of constructing those strategies in the initial phases, and for the few years that I ran those strategies, they are still very popular in the market even as we speak. So, we have to be mindful of the fact that this strategy calls for a different kind of temperament, a different kind of mindset on the behalf of the manager as well. And if that is the case, and if he has the experience, then we can see better performance or better success out of some of these focus strategies. Now, when we look at some of the data around us, also it further reinforces our belief in this concept. And if we just look at the Nifty and the BSE 500, two absolutely polarized indices. One is a 50 stock narrow index, the other one is a 500 stock index. But in both the cases, year after year, we have seen that it is just a few set of 10 odd stocks which actually contributed to the bulk of the returns for a number of years, as you can see in front of you. So again, it underscores the fact that it is less is more. Just adding to the number of stocks beyond a particular point does not really help. But people, managers, investors still continue to do that, basically with the objective that we can bring in diversification and reduce risk. But even when we look at volatility as a substitute for risk and as a proxy for risk, we find that between a Sensex or a Nifty and a 200 stock BSE 200, there is not much difference in the volatility over a longer period of time. 5-year data tells us that the volatility of these indices is exactly the same. So again, it defies or it challenges the assumption that adding stocks actually brings in more, reduces risk. It only detracts from performance because you are allotting your monies to things which are probably not going to contribute at the end of the day. It's going to take away your time and attention in the bargain. So I think that again is something that we need to think of. Lastly, and this is something which we are all experiencing in the last some time, we find that there is a very few set of stocks which do well particularly over medium to long term. Now, if you look at sector by sector, there's a huge divergence between the best performer and the worst performer in the same sector. Autos, technology, banking, of course, we all know the classic story between private and public sector banks. But sector by sector, I can even call out other sectors like FMCG, oil and gas. You'll see the same phenomenon. Vast disparity between the best performer and the worst performer in the sector. So again, underscoring the fact that it's about stock selection. It is about concentrating on those few big ideas which will make all the difference. So with this background and this belief, we have launched this fund. Some of the key features that we will have in this fund is one, as I likely said, it is going to essentially be a 20 stock portfolio. We will keep a multi-cap format. We know that, look, so running a concentrated strategy is about risk management. Volatility and risk are two different things. Volatility is more about daily stock price movement. Maybe that we may not be able to control beyond a point because it's not another. But risk is more fundamental in nature. Risk is about about the fundamental nature of the business, the underlying business of the stock that you're owning, what is its competitive positioning and everything around it. So risk is something which we have to control, not as much of the volatility in this portfolio, because in a concentrated strategy, if few of your ideas really create fatal accidents, then you can have a big problem. So the health hygiene of the fund is something that one has to really focus on. But otherwise, if you're focused on that, if you manage that, then this strategy is actually absolutely well designed for outperformance. There's just no way it can not outperform if you conduct it in the right healthy manner, because all your positions are very meaningful. You will have a fair departure from the index. You own index stocks, but you will still have a difference, a very large difference in terms of the weights you will have. So if a stock has 3% in the index and you have 7%, and if the stock does well, you can just imagine what will be the impact of that on your fund or on your portfolio. So, but it is important to control the risk. And in our case, we believe that we have been a very, very process-oriented house. You are familiar with the way we operate. Many of you are familiar. We have a process which has been around for a very long and consistent period of time throughout since our inception, and we have never changed it. And it has allowed us not as much to generate returns, but avoid accidents. And avoiding accidents, big-time accidents, is an integral part of money management. Even more so than having the right positive ideas. So I think our conviction in our process actually tells us that, it has been able to avoid accidents very, very well in the course of many years. There have been several accidents in the last 2-3 years in the market, and we have been happy, touch wood, God has been kind that we've not been associated with any of them. Even starting from Satyam Computers, which we at that point in time did not have in any of our portfolios. So again, this is something which we will be leaning on heavily in order to conduct this portfolio. But we know that there are risks. At least there are perceived risks. Clients do perceive that there's a risk element. So in that regard, we are building in some safeguards. What we are doing is that we'll follow a multi-cap approach. It will have a good combination of large cap, mid cap, small cap. Large caps, of course, will be dominant, but we'll keep that between 50 and 70%. We'll also give ourselves enough room to play out some high conviction mid cap and small cap ideas. Small caps will restrict ourselves to a maximum of 20%. Because we know that small caps are relatively more volatile, so we don't want to add to the complexity of the fund. But we'll play a good amount of mid caps, say on an average 30 to 40% could be in the mid cap space. The other thing that we will do is that we will have a good blend of growth as well as value. Normally, all these strategies are very, very predominantly growth oriented, materially growth oriented. We are good at value. We run a very successful value strategy called the Contra Fund, which you guys, many of you would be aware of. It's been a very, very consistent performer over a very long period of time for the last 13 years. And our process supports identification of value stocks. Our framework identifies value stocks very well. And we think that even though value as a concept probably seems to be dead around the world and maybe in India, for us, the experience has been different. We think if value stocks are picked in a nice disciplined manner, and it's possible to make money out of value ideas as well. So we will create that blend in this portfolio too. 60 to 70%, however, will still be growth oriented. So it will be a dominance of growth, but 30% to 40% will be in value stocks as well. Now we know that markets do rotate between growth and value. They rotate between large cap, mid caps, small caps. So we'll make that adequate provision so it provides a more balanced approach to the portfolio. Of course, it will be a bottom-up driven strategy. We don't think we will be emphasizing a lot of sectors out here, but we will be emphasizing themes. Many themes could play out through the route of this portfolio: digitization, automation, Atmanirbhar, domestic manufacturing, defense, changing consumer lifestyles post-COVID. All these things we will try to incorporate in this strategy. So we will think more thematically here than thinking sectorally. So lastly, basically, why should one invest here? Look, we don't think this is a strategy which is launched here with a very opportunistic mindset. This is a strategy which, in our view, is worthy of consideration at any point in time. And simply because it's, like as I said, it's a high conviction portfolio. You can't not make good money or outperform the market unless you create fatal positions for yourself, or you really bring in very bad quality stuff. Otherwise, there's just no way somebody can, not run this strategy reasonably successfully, at least over a 2-3 year kind of a time frame, if not less. Well, this was not timed for this. We were in fact planning this product much earlier at the beginning of the year, but unfortunately the pandemic hit us. So there's nothing opportunistic. But now when we are in the midst of this crisis, we are realizing that the importance of focus, importance of more due diligence, more intensive analytics, running things in a very healthy manner, meticulous approach, extraordinary vigil around what you own will become even more and more important. Money making will be there. It will be very interesting. It will be very rewarding, but it's going to be very, very challenging as well as we go along, is my feeling, compared to what it has been in the past. So therefore, I think the importance of focusing even in other strategies will become even more relevant as time rolls along. With this, let me stop here. I think I've spoken for a little longer than I thought. We still have about 20 odd minutes to actually go through some Q&A. So I'll ask Paras to please shoot some questions and clarifications or whatever else that you would like to know. Thank you once again, Ashika, for organizing this, and thank you everyone for a patient listening.
It's always our pleasure to hear from you. And the first question, to all our participants, whosoever want to ask questions can raise hand or put it on the chat box. And before the question assembles, one question from my side, that either in the start of a bull market, people make easy money, or at the end of a bull market, people make easy money. probably at the climax stage or at the early stage when the fall has been massive and there is a recovery. So what do you think that we are in a bull market and many of the themes have played out? So in this context, what all themes are prominent which you think that they have not been captured by the market yet and you see a large tailwind? And the third is about your conviction contra bets. So this is what I think our participants also want to hear. So what is the contra bet which one can take at this point in time, and what is your thought process behind that?
No, well, I think there are, like as I said, some sections of the market which are still not done well, and they are lagging both in terms of valuations as well as in terms of fundamental recovery. So clearly in financials we feel that there is a room, and particularly many of these banks have got very strongly capitalized in the last few months, and whenever they will be the biggest lenders when the credit cycle actually resumes. So to that extent, therefore, that is one area, we can move with a little more confidence. Of course, we require, it might take a little longer to pan out. See, today, everybody is of the view, nobody knows as to how life has been after August 31st on the moratorium. But if, let's say, the trend works out even better, and hopefully it should, the way things have been since March, April, if the trend continues, and when come first of the first few months of October, and we get some more confidence around how the asset quality trends have behaved, I think we can. I won't be surprised if we see a very sharp rally in that space, because that's underperformed. It is also not at all extended in terms of valuations. In fact, many of the things out there are reasonably cheap, and they are, again, as I said, even though they are balance sheet businesses, many of them are actually getting stronger in terms of capitalization. There are some which we want to clearly still avoid, but there is a good set of few companies, few banks which are meaningful. There are even pockets of NBFCs, particularly the ones which are actually lending to, which have underlying collateral, which is more secure lending. Those entities also, whether it is gold financing, auto financing, mortgages, those are also kind of reasonably in decent place today. I think parts of consumer discretionary, once again, particularly I mentioned the ones which are geared more towards urban centers and urban demand, they are not doing well. Some retailers, high-end retailers also, some pockets of autos, these are not something which are doing have not done as well. And because places like Mumbai, Delhi, Chennai, Kolkata also to some extent, and Pune, these are the centers which have been in the thick of the crisis. So once, and they are also very large centers of demand. So once they open up, that could lead to a different, set of businesses which can do well. I think some parts of telecom, of course, there are not many players, but telecom, which did very well in the first half of the year, has actually underperformed meaningfully. Moreover, the whole AGR related issue, which was bogging down, is actually now behind us. Yes, maybe the markets has been disappointed that price hikes, etc., have not come about quickly. But I think that's just a matter of time. And the industry has moved well on the consolidation phase. And I think even in terms of the key performance indicators of these telecom companies, things are getting better. Plus, of course, it's a great play on digitization. It's a great play on work from home and the whole automation, opportunity. So that is another area which we think is quite promising. Yeah, I mean, there are some other there are these platform businesses which attract us. I mean, capital market plays, the whole some of the plays which are around this whole huge surge in capital market activity, retail participation, financialization of savings. There are platform companies which actually have very well placed from a balance sheet perspective. No challenge to balance sheet, but they are just providing the software platform, and people are coming on either trading on it or doing their ancillary, shares related activity on that, or B2B platforms which are combining, which are bringing face to face one business with another. Those kind of businesses are looking very promising. Certain insurance plays are also quite interesting. There are parts of even the asset management industry which can show up some decent successes. Of course, there is a good new set of new crop of companies which are coming through the IPO route, and many of them also are very, very interesting from a future potential perspective. We have had a chance to take a good advantage of many IPOs in the last 3-4 years to our benefit, and it's I think that will throw up another good number of distinct opportunities which are not currently available today. So I think there are pockets of the market. I think some parts of oil and gas, I mean, particularly utilities, gas utilities, have become cheap. Not cheap, but at least I would say attractive. They are at least cheaper than what they were pre-pandemic. So, and they have a vast opportunity. The whole gas from traditional fuels to gas story is only going to become larger and larger. So that is another theme which we will play out. Defense, there is opportunities which can come up. So I think these are some things which come to my mind. Of course, there's a whole manufacturing related opportunities. Some of them are visible, some are not very clearly visible at this stage, whether it is in manufacturing of consumer discretionary products, durables, or even things like chemicals and the others, commodities. Parts of consumer discretionary, like I've mentioned, which is particularly to do with home improvement, white goods. These may look somewhat, some may look expensive, but all of them are not. And there are some which are quite cheap, not cheap, but I would say quite attractive as well. So there are still pockets of the market which are not fully, I would say, in zones which are absolutely exotic as far as valuations are concerned, and where the opportunity is still quite valid from a 3 to 5 year perspective, if not more.
So one question is from Mr. Sujit Shah. So I would ask, he is from our branch. So I would ask him to unmute himself, Mr. Sujit, if you can hear me. I've unmuted, and he can put up the question. Mr. Sujit, can you hear me? So we'll take up one more question. Hello. Yeah, Mr. Sujit, you can put a question to Mr. Taher, please.
Hello.
Yes, please go ahead.
Recent কোনো market downtrend যাওয়ার কোনো ইয়ে আছে কি?
So he is asking in Bengali, so I'll translate if you.
Yeah, please.
Try to address some of the questions in Hindi as well.
Yeah, जी, ठीक है. मुझे सुनाई नहीं दे रहा है. I can't hear.
Achha. He was asking, do you fear for any kind of downtrend in the market? So
yeah, तो मैंने जैसे
obvious fear which is there with many of the retail investors कि इतना market चढ़ गया है, अब यहाँ से गिरने का कोई chance है, risk लगता है. What should one do, a retail investor?
देखिए सुजीत जी, मार्केट का कोई भी लेवल हो, किसी भी समय हो, इक्विटी इन्वेस्टर के लिए हमेशा तैयारी होनी चाहिए कि वो 10, 12, 15% का रिएक्शन झेल सके. ओके, मार्केट ने अगर 50% नीचे से चला है तो उसका हक है 10-15% गिरने का, और उसके लिए हमें तैयार रहना चाहिए. तो आई थिंक दैट इज, एंड इट लॉजिकली लुक्स टू मी ऑल्सो, मुझे भी जैसे मैंने कहा भी कि मुझे भी लगता है कि अगर थोड़ा करेक्शन आ गया तो अच्छा रहेगा. इनफैक्ट इट विल बी हेल्दी फॉर द मार्केट. ओके, एंड वैसे भी मतलब अभी ऊपर जाने के लिए यू नीड टू हैव सम रीजंस. आइदर आपको नंबर्स अच्छे लगने लगे या तो भाव अच्छे हो. बट इफ बोथ आर नॉट देयर देन यू हैव अ प्रॉब्लम. सो आई थिंक वी आर कमिंग टू द स्टेज, एज आई सेड, अप टू नाउ मार्केट्स ने जो किया वो लगभग सही किया है. But now यहाँ से अगर if another 15-20% markets were to go up without anything changing in the world, I think then after that जो अगर उसके बाद fall आया तो और भी ज़्यादा तकलीफ होगी. तो उससे अच्छा है कि I think here we either spend some more time, we go through some time correction, or maybe we go through some absolute correction, we step back a little bit जहाँ से हमें थोड़ा तब तक हमें कुछ earnings की भी visibility का समझ में आए. This will be the first quarter when businesses will go back to normal. तो सितंबर क्वार्टर रिजल्ट्स आएंगे, वो भी थोड़े इंटरेस्टिंग रहेंगे, जानने जैसे रहेंगे क्या हुआ क्या नहीं हुआ. सो आई एग्री कि थोड़ा बहुत करेक्शन इज ड्यू एंड वन शुड बी केयरफुल. आई मीन देयर आर पॉकेट्स वेयर यू कैन स्टिल कंटिन्यू, बट देन इट्स नॉट अ मार्केट वेयर यू कैन गेट कैरिड अवे और आप जो चाहो मन में, मतलब एकदम वी डोंट नीड टू बिहेव लाइक टिपिकल रिटेल इन्वेस्टर्स.
Okay, thank you so much. So next question is from Mr. Chaudhary. So I have taken him on panel. So Chaudhary ji, आप अपने आप को unmute कीजिए and put up questions. Hello. So before he's prepared to put up a question, so I think
Yeah, he's come.
Yes, come. Chaudhary ji. Hello, Mr. Chaudhary. Can you hear me? So before that, there is one more question from Mr. Arunava Ghosh. So he is asking that the impact of new SEBI ruling on the multi-cap funds, if it applies on focused fund also, as we see it as a multi-cap fund, then investors are compelled to hold at least 25% of small caps, which are at quite high risk at the current scenario. If investors have to buy and hold small caps with P ratio of 80 and higher, then that is not very helpful for us. Please help us on this point.
Yes, so basically, this new SEBI principles guidelines do not apply to the focus category. Focus category is a category which can be multi-cap in nature, but it is the defining reason is not the market caps. The defining point for a focus strategy is how many stocks you own. And you cannot exceed 30 stocks at any point. तो maximum आप 30 stock ले सकते हो, लेकिन आप उसमें large cap भरिए, small cap भरिए, mid cap भरिए, चाहे जो करिए. So it is not governed by the rules which have now been brought to the multi-cap strategy, multi-cap segment. हमारी तरफ से, because to bring the balance in this fund, we are going to have a multi-cap approach. So it does not apply to focus category, otherwise also, other funds also, and even to this new fund that we are planning to launch. But of course, some of the other industry players, and the other thing is for us, again at Invesco, our Invesco multi-cap fund is exactly in line with where the SEBI regulations are today. So we have always been running it like that in the true spirit of a multi-cap, which is what SEBI wants. So we have the least challenge. In fact, we don't have to do any churn in our portfolio at all as things stand today. But for the larger players, larger AUMs in multi-caps, they will have some trouble. But let's see. There are representations from the industry to SEBI as well. We'll have to see what they come up with. What are the outcomes? They might give some time, or they might extend the time limit. They might give some leeway. They might introduce another category. Let's see what comes out of it. Plus, it is still 4 months away, and it is going to be based on data for December 31st. So I don't think it's a very healthy thing that retail investors should pile on to mid and small caps, thinking that large funds will, mutual funds will reorient their strategy or हमें फायदा हो जाएगा. I think that is not a good starting point for any investor to invest in mid and small caps. Invest in mid and small caps if you think you have enough time, at least a 2-3 year horizon, if not more. Plus, mid and small caps generally do well when the domestic growth cycle is better. So when the domestic growth cycle improves, there will be clearly a preference, and mid and small caps will outperform. If you are buying from that perspective, it's a good thing. But don't buy with the expectation that, okay, I'm buying today and somebody else is going to come and buy 2 months later or 2 weeks later. That's not a good way of investing in mid and small cap funds. It is a very risky way of thinking about it.
Okay. So we have one more question from Dr. Bipin Shah. So Dr. Bipin Shah, if you are there, you can put up the question.
What should be the profit making for the equity shares? 5 years, 10 years?
Dr. Ji, I think, Dr. Shah, we should think in terms of, at current reckoning, I think India का जो growth profile है, और longer term में जो हो सकता है, we all know what is the potential of our country. I think somewhere between 10 to 15% compounded is a good number to think of. And especially जब many other asset classes are not able to deliver that, and even fixed income returns are going to remain low because interest rates are low, a 10 to 15% number is a very healthy number. लेकिन मैं ये भी कहूँगा कि compared to what it was 10 years ago, which was more like 15 to 20%, we now have to think in terms of 10 to 15%.
Right. So there is one more question from Mr. Sashikant Gupta.
Sorry, Paras, I'll have to just alert you that I need to probably log out in the next 2-3 minutes.
5:50. So
yeah, we can take the last 2 questions.
Okay, last 2 questions and we'll conclude then.
Thank
you. We are on time, I think, that way.
Yeah, thank you very much for accommodating.
Yeah, so one question is from Mr. Gupta. He is asking about pharma and auto sector. So your views on that?
So look, pharma is particularly now, it is a sector where we need to do things which are very bottom up. I mean, you have to be very particular about the companies that you buy, because every company is now different. A Dr. Reddy is different from a Lupin, is different from a Sun Pharma, is different from a Divi's, and each has their own business models. Ab wo wala pharma nahi raha jahan, everybody is doing the same thing. There are companies which are now pursuing specialty chemicals. There are some which are focused on the Indian domestic market. There are some who are now continuing to do what they were doing earlier, which was generic. Business models have changed, return profiles are changing. उनके जो investment requirements है, capital requirements है, वो भी change हो रहे हैं. So I think you have to go by individual stock selection. What is the individual strategy of each of these pharma companies, and then try and accommodate 2 or 3 stocks, or maybe 3-4 stocks should be adequate to cover the pharma sector. So I think that is you have to take a very, very bottom-up differentiated approach in pharma. As far as autos is concerned, well, I think some of the commercial auto players are looking a little more attractive at this stage compared to the commercial autos. Plus, maybe car manufacturers are looking a little better. I think the rural sector players have, in terms of valuations, they look a little extended. So everything from a little bit of tractors and two-wheelers is to us looking a little stretched, although they can, they are all good quality companies. But in terms of valuations, I think they have done a fair bit. But I think those which are more in the cyclical segment of commercial vehicles, even urban-centric products like cars, I think maybe there could be some more opportunity out there.
So last time I'll try Mr. Chaudhary. He is there online. So whether you can hear Mr. Chaudhary, you want to put up a question? Are you there? So Chaudhary ji, I think we'll take a last question. The other question is, Chaudhary ji is not live, I think, at this point. So one question about what is your view on banking sector? And you said that there could be a contra bet in banking space as well.
Yes, I think contra bet in banking is there, but we have to be careful of the stock selection again out there. We don't want to take not very, those banks which are the strongest are also available cheap right now. So you don't need to go to the mid-size or the small banks or the not so great quality banks. Because जो अच्छे बैंक है वही सस्ते हो गए, तो आपको और ज्यादा रिस्क लेने की कोई जरूरत नहीं. Along with which, जैसे मैंने कहा, some NBFCs also, लेकिन जहाँ पे secured lending है, those are preferred. Third is some asset managers and capital market related plays non-lending business, जहाँ पे balance sheet का related है, insurance companies हो गई, asset managers हो गई, companies like CDSL type जैसी हो गई, platform वाली companies, वो हमें अच्छी लगती है. So I think these are opportunities still. Banking, I think, is still quite contra at this stage, as is what we feel.
Great. So with this now we'll conclude, and so we are bang on time, 5:55.
Thank you very much.
At 6. And thank you so much for a lovely presentation. So we hope to do it more with you in future.
We'll certainly make time for that. Yeah, sure. Thank you all for participating. Thanks for your patient listening. And we'll connect soon. Until then, please stay safe and take care of yourselves. Thank you once again, Paras and Ashika, for making this happen.
And all the best for your new.
Thank you. And we look forward to the support of all you guys and participants.
Sure. I'll request all of you to have a closer look at it. And I'm sure that the kind of returns Contra Fund has given, this probably also is going to be one of its kind.
Yeah.
So thank you so much, all of you.
Thank you. Bye. Thank you.
Bye.